Okay, study 10 on group accounts. The statement of financial position of Genco and its investors company PICO and ESCO at 31 December 2005 are shown below. We are given a statement of financial position as at 34 December 2005. The details are non-current assets. Under non-current assets, we have freehold, plants, and investments. Then, under current asset, we have inventory, receivables, and cash. Then, under equity and liability, we have the equity, share capital, and retained earning. Then we proceed to the non-current liability, where we have 12% loan stock, and under current liability we have trade payable, bank overdrafts. Then this gives us the total equities and liability. Then for the additional information, the first note says that JCO acquired 600,000 shares in PICO. JCO acquired 600,000 shares in PICO on 1st January 2000 for 1 million, when the retained earning of P were 200,000. That's the first note. At the date of acquisition of P, the fair value of its pre-owned property was considered to be 400,000 greater than its value in P's statement of financial position. And PICO had acquired the property in 2000, and the building element comprises of 50%, which is depreciated on cost over 40 years. So this represents asset at acquisition. JCO acquired 225,000 shares, ordinary shares in X on 1st January 2004 for 500,000, when the retained earning of ESCO were 150,000. Then PICO manufactured a component used by both JCO and ESCO. Transfer are made by P at cost plus 25%. JCO had 100,000 inventory of this component at 34 December 2005. In the same period, JCO sold to ESCO, of which ESCO had 80,000 of this inventory as at the year end, and JCO had marked up this good by 25%. That is, JCO had two companies, and the transfer of goods was made to the two company. So that is exactly what I know is saying, which I'm going to explain the treatment as we proceed. The goodwill in PICO is impaired and should be written off. That means any goodwill we arrive at in the book of PICO should be written off. Then an impairment loss of 92,000 is to recognize on the investment in in ESCO. Non-controlling interest is valued at full fair value. Then PICO share were trading at 1.6 just prior to the acquisition. So that is a requirement. So you are required to prepare the consolidated financial position as at 31st December 2005. So before we do anything, the first thing we need to do is to sketch out our solution. So we have J group consolidated statement of financial we move to equity and liability. So under the equity we have share capital, retained earning, then non-controlling interest will come into. Having done this, we move to the non-current liability as given in the question. Under non-current liability, what do we have? We are given 12% loan stock. 12% loan stock. Then we also have current liability. Under current liability, what do we have? Let's check. Okay, we have trade payable and bank overdraft. We have trade payable and bank overdraft. So summing up all this, we equals to our what? Our net asset. Now we can start reviewing the notes to the account one after the other. We can start reviewing the notes to the account one after the what? The other. Now the first one we need to do is to look at the shareholding percentage. Now the first one says that J acquire 600,000 shares in what? In P. J acquires 600,000 shares in P. How many shares do we have in P? P has what? 1,000 shares. So that means that we have J in P. J in P, that is 600 over 1,000 times 100% over 1. This gives us 60%. Then our NCR here equal to what? 40%. So that is the first acquisition we have. Then the next acquisition says that what? J acquired 225 ordinary shares in what? In S. J acquired 225 ordinary shares in S. How many shares do we have in X? In X we have what? 750, and we acquire 225%. In S we have what? 750. So here we have J in X, 225 over 750 times 100 over 1. So this gives us 30%. So this is an example of what? Associate. So in that case our group structure will look like this: J P X. X is an associate because we have 30%. Under this S we have just significant influence but not control, but here is subsidiary because we have control. Okay, so that is how that note looks like. So we can proceed to the next note now, which says that what? At the date of acquisition of Pico, the fair value of its property was 400,000 greater than its what? Its value in Pico state of financial position. That means that there is a revaluation surplus or fair value surplus at the date of what? Acquisition, and the value is what? 400,000. So the first thing we need to do is this, because it occurs at the date of what? Acquisition. So we have fair value adjustment, which is what? Is 400. So our entry is that we are going to debit our freehold property and we are going to credit it to asset at acquisition. So let's proceed to read the remainder of the note. This is where we stopped. Then Pico had acquired the property in January 2000 and the building element comprises of what? Of 50%, and this is to be depreciated on cost over what? 40%. The property was acquired in 2000 and we are preparing our account for 2000 and what? 2005. So that means that we should depreciate it for a period of what? 6 years. That means from the 2000, 2001, 2, 3, 4 and 5. So that makes it what? 6 years. But we are going to depreciate only the portion of the buildings. Land is not a depreciable asset under IAS 16. So that means that our depreciation is going to equal to our depreciation will equal to what? 400,000 times 50%, because we are taking only the portion of what? Buildings. Then we are going to divide it for over what? 40 years, and this will be charged for how many years? 6 years, because the asset was from 2000 till date is what? 6 year old. So that means our depreciation adjustment will equal to what? 30. 400,000 is the value of the total asset, but the building element is what? 50. So the annual depreciation will be divided by what? 40 years, and we are charging it for 6 years. That's why I'm multiplying it by what? By 6. So this is our depreciation charge. 6 what? 6 years. That is our depreciation charge. So the treatment is that this depreciation charge, the treatment for this is that we are going to credit our freehold with this freehold property. Then we are going to debit the profit or loss of who? Of P, the subsidiary, because we revalue it what? Its asset. So we are going to charge it directly to the profit of P before we apportion it to into either pre-acquisition or post-acquisition reserve. We have to first of all deduct the value of depreciation from this profit first. So that is what the note is all about. Any asset that occurred at the date of acquisition and it involved depreciation, and the asset of the subsidiary was the one that was revalued, any depreciation adjustment has to be charged directly into the subsidiary's profit or loss, not that of the group. It will be charged to the group's profit or loss if it occur in the holding company's what? Property, plant and equipment. So note 1 is treated, 2 is treated, note 3 is treated as well. Now let's look at note 4. PCO, that is the holding company, manufacture a component used by both JCO and SCO. Then transfer are made by P at cost plus what? 25%. JCO had 100,000 of inventory of this component at 31st of December. In the same period, JCO sold goods to S, of which S had 80,000 of this inventory. What happened is that PCO manufactures this is used by J. P is the subsidiary. P is the what? Is the subsidiary. That is, let's look at the group structure. P is the subsidiary. He manufactures a goods that is being used by holding company and also the what? The associate. So that means that there is going to be two unrealized profit. That is, he manufactures a goods that is being used by both J and S. That is the holding company and what? Subsidiary. And he made the transfer to them at cost plus what? 25%. He made the transfer to them at cost plus 25%. Now, J, the holding company, still have 100,000 worth of these goods in its inventory. That means that we're going to compute unrealized profit for J based on this 100,000. Then JCO sold goods to S, that is the holding company himself. Now transfer goods to who? To X, okay, and of which SCO had 80,000 of this in his stock. So the holding company now transfer goods to S, and S still has 80,000 of this in his what? In his inventory. That means that we're going to compute unrealized profit for associate based on this 80,000, and we're going to compute unrealized profit for holding company based on this what? 100,000. But how we're going to pass the journals for associate will be quite different from how we're going to pass the journals for who? For the holding company. Now let's proceed to see that. Third workings, unrealized what? Profit. Now the first one is that on sales by P to J, that is from the subsidiary to the holding company. So we have 100 times what? 25 over 100 plus 25, and this gives us how much? This gives us 20. This gives us what? 20. So this gives us what? This gives us 20. So our journals is very easy for this ones now. All that is required from us is to debit and credit. We are going to credit the group inventory, but we are going to debit the profit or loss of the subsidiaries. So we are going to credit the P or L of what? Of P. We are going to credit P or L of what? P. The same thing we are doing for the fair value adjustment is the same entry we are going to pass for this one as well. We are going to credit the profit of the subsidiaries directly with this value. With this value, we are debiting his profit directly with this what? Value. Then the second one is on sales by the holding company to who? To S, that is the associate. So this one is what? 80 into 25 over 100 plus 25. So this gives us 4.8. This gives us 4.8. 4.8. So our entry is that we're going to debit the profit or loss of P or L of what? Of the holding company, that is the group. Then we are going to credit, we are not going to credit inventory because associate inventories will not be consolidated. Instead, we are going to credit investment in associate. So this is what we are going to pass for this. That is on sales by what? J to S. So in this case, we are not going to credit inventory because associate is not part of the group, but rather we are going to credit its investment with us, to reduce the value of its what investment with us. So that is the end of that entries.